All right, let's set the scene. The date is March 2026. There's a 48-hour ultimatum ticking down in the Strait of Hormuz, and a full quarter of the world's oil supply is hanging in the balance. The markets, they are a sea of red. Panic is absolutely in the air. Now, your gut instinct, your natural reaction, is to sell everything and run for the hills. But what if this exact moment, this point of maximum fear, is actually something else entirely?
Okay, so let's dive right into this chaos. We're going to need to understand the anatomy of this panic, what it's made of, before we can even begin to see the opportunity that might be hidden inside of it.
So first up, let's talk about the VIX. You might have heard it called the market's fear gauge. It's basically a measure of expected volatility, and wow, has it spiked. It's jumped to 25. Now, a number like that, it signals extreme anxiety. It means investors are paying a huge premium to protect their portfolios. This is the market's pulse, and right now it is absolutely racing.
And that, right there, leads to the billion-dollar question, the one every single investor is asking themselves as they're watching their portfolios just bleed out. I mean, when it feels like the entire world is selling, is it completely insane to even think about doing anything else?
And make no mistake, the damage is very real. The S&P 500 has just been hammered. We're talking a drop of over 7% from its recent highs, coming off a brutal 4-week losing streak. The selling pressure is just relentless, and a lot of key technical support levels are starting to break.
And here, this is the engine driving the whole panic. Brent crude oil has spiked to $111 a barrel. With a quarter of the world's supply at risk in the Strait of Hormuz, this isn't just some scary headline. No, this is a direct threat to the entire global economy.
But what if this wall of sound, this peak fear, is actually a contrarian signal? What if the exact moment things feel the absolute worst is precisely when the tide is about to turn? This brings us to what's called the peak fear paradox, and it builds a pretty powerful case for thinking very, very differently. So, the crucial concept to get your head around here is something called market habituation. Think about it like this. The market, just like a person, can only stay in a state of high alert panic for so long before it just gets exhausted. When you get to a point where even the absolute worst headlines can't push prices any lower, that's a huge sign that all the potential panic sellers have already sold. They're gone.
And this is not some new idea. This famous quote, "Buy when there's blood in the streets," it actually comes from Baron Rothschild way back during the chaos of the Napoleonic Wars. He understood that the greatest fortunes are made by having the courage to act when everyone else is absolutely terrified.
And history shows us this pattern again and again. It's fascinating. In 2003, the market bottomed on the very day the invasion of Iraq began. In 2020, the recovery started right as the world was shutting down for COVID. You see, the market doesn't wait for good news. It bottoms when uncertainty gets replaced by a known, even if it's a frightening reality. And that question mark for 2026? Well, that's what we're here to figure out.
Okay, so if we accept that this might be an opportunity, how in the world do you act on it without getting totally wiped out? Well, the answer isn't just to go out and buy anything that's down. No, you have to use a disciplined framework, one built around 3 specific shields.
These are the 3 non-negotiables. You're looking for a company with a strong competitive advantage. That's the moat. You need a proven track record of growth. And, this is so important, you need to buy it at a discount. Not 1, not 2, but all 3 have to be there.
So shield number 1 is the moat. This is what makes a business truly resilient. It's what protects it. Think about a company like Microsoft. Its customers can't just flip a switch and move to a competitor without massive disruption in cost. That is a powerful, powerful defense in a chaotic world.
All right, shield number 2 is all about reliability. We need to forget about the story stocks that are just promising big profits someday in the future. In a crisis, you want businesses that are already gushing cash. We're looking for a consistent, proven track record, something like 15–20% earnings growth year in and year out.
And now for the final, and maybe the most crucial shield right now, your margin of safety. You have to buy at the right price. A fantastic company can still be a terrible investment if you overpay for it. What we're looking for is a clear, obvious discount to where it has historically traded.
This table right here shows you exactly what I'm talking about. Let's take a market leader, say a top semiconductor company. Historically, it trades at a price-to-earnings ratio of around 44. But right now, in the middle of all this panic, you can buy it for 35 times earnings. That's a 20% discount on a world-class business, basically handed to you because of the market's fear. That is the opportunity.
Now here's the really cool part. This strategy isn't just about playing defense. It's about setting yourself up for the rebound, which will come, and creating what we call a powerful springboard effect. Let's break down this dual benefit, because it's pretty powerful. On one side, that discounted valuation creates a kind of floor under the stock price. Other value investors are going to see that deal and step in. But on the other side, because these are fundamentally amazing companies, they're always the first ones to snap back hard when sentiment finally improves. So you get downside protection and maximum upside exposure. It's the best of both worlds.
Okay, let's make this totally concrete. How do we take this framework and apply it to the specific challenges of the Hormuz crisis, like right now?
In a crisis, you want to own the things that are simply indispensable. Think of them as the digital utilities of our time. Even if there's a conflict, businesses and governments have to pay for cybersecurity. They have to pay for their cloud infrastructure from providers like Amazon or Microsoft. And they absolutely need the advanced chips that power everything. These are the last things that ever get cut from a budget.
And here it is. This is probably the simplest but most important filter of all. A company with a mountain of debt or earnings that are all over the place, that is not a high-quality company. I don't care how cheap it looks. In this kind of environment, we are only interested in companies with fortress-like balance sheets, period. End of story.
You know, it all comes back to that classic piece of wisdom from Warren Buffett. He said it perfectly. We are trying to find those wonderful companies, the ones with the wide moats and the consistent growth, and we're using the market's panic to get them at that fair price.
So, as we wrap this up, here's the final thought I want to leave you with. A crisis like this, it's always a test. It's basically designed to shake out the impatient and transfer their wealth to the patient. Right now, the panic is deafening, but the historical pattern is crystal clear. The only question is, which side of that wealth transfer do you want to be on?